Welcome to today's deep dive on the US versus Eurozone crypto regulation. What changes for issuers, investors, and innovation? Over the few moments, I'll break down how these two major regulatory regimes are evolving, what that means for tokenization, stablecoins, and institutional flows, and why this matters for anyone building or investing in crypto in 2025. Let's begin. Okay, I pulled a few slides just to help me walk through what are the differences in the regulation standpoint from crypto between the US and the European Union. I think it's very important that you keep yourselves up to breast with what's going on because it's so many moving parts involved. So why this matters. So before diving into the laws and regimes, let's frame why this comparison matters. Crypto's promise hinges on legal clarity. If tokenized securities, stablecoins, and cross-chain finance are ever going to scale, they need regulatory infrastructure that actually works. That's the point. Institutions want predictable rules, not surprise lawsuits, which is what has happened in the previous administration, the US, headed by Biden and the team. Capital flows will favor regions where rules are defensible and scalable. This is more than geopolitics. It's capital allocation. Which regimes gives you safer, simpler entry? That's the lens I'll use today as I compare the US and the Eurozone. Let's start with the big picture. 2 years ago, the US and Europe looked worlds apart in how they approached digital assets. The US was running on enforcement and the EU on codified law. Fast forward now to 2025 and both are finally maturing, just at very different speeds. In the United States, the Genius Act and the Clarity Act are reshaping the legal terrain. The first gives stablecoins a formal federal framework that one-to-one reserve mandates, independent audits, and the FDIC-style licensing. The second defines when a digital asset is a security versus a commodity, giving developers and investors real legal parameters to work with. Meanwhile, the Eurozone's MiCA regulation is already live and kicking, setting clear rules for crypto service providers, issuers, and stablecoins. What's changed recently is how ESMA has stepped up to centralized enforcement and indeed reduced fragmentation between member states. So today, the US is playing catch up through legislation while Europe is more focused on execution. Both are converging but through completely opposite paths. Now this is actually an interesting table that would help navigate what are the actual comparison between the various crypto regulations in both regions. So let's go through this slide carefully because these added pillars are exactly what's changing the game right now. First, regulatory model and approach. In the US, while enforcement has historically ruled, new legislation like the Genius Act and the Clarity Act are being introduced to shift the paradigm towards clarity. The Genius Act aims to regulate stablecoins, require backing, and set issuer standards. Clarity seeks to define digital assets, exemptions, and registration rules for mature crypto services. Meanwhile, in the EU, MiCA is already law and plans are underway to empower ESMA to help supervise exchanges, custodians, and major crypto firms across member states to reduce that fragmentation that I commented earlier on. Next, stablecoin regulation and clarity. In the US, the Genius Act will demand strict one-to-one backing, auditing, and qualified issuers. A framework banks and fintechs can use to issue stablecoins. That is key. On the EU side, stablecoins are already regulated under MiCA as asset referenced or e-money tokens through licensing, reserve and disclosure rules baked in. Then tokenization and RWAs. The US issuers still operate under legacy securities law unless new definitions give exemptions. Clarity is trying that. The EU, by contrast, has clearer issuer obligations under MiCA for crypto asset issuance and trading, which gives on-chain tokenized products more legal certainty. On the market infrastructure side, the US proposals in clarity aim to define exchanges, brokers, custody rules more precisely. Meanwhile, EU regulators are actively pushing to centralize crypto infrastructure supervision under ESMA to avoid nation-by-nation fragmentation. That is also an important feature. Investor protection is baked into the US bills. Mandatory disclosures, backing standards, conflict of interest rules. In the EU, MiCA already mandates disclosures, transparency, risk safeguards, and ESMA guidance such as minimum competence requirements. On the topic of cross-border coordination, the US legislation seeks to reduce conflicting state patchworks, but truly unified rules are further off. On the other hand, EU is building passporting and harmonized licensing so crypto firms can operate across the states with just one license. Lastly, speed of product approvals. The US could benefit if the new acts make approvals faster for stablecoins and token products. In the EU, on the other hand, compliant firms have pathways via MiCA to get licenses and scale. So by adding these bullets, the US Genius and Clarity Acts and the EU's ESMA expansion, we cover the critical regulatory levers that will decide which block leads the next crypto infrastructure wave. So when we talk about regulatory clarity, this is the year it finally started to take shape in the US. We've got the Genius Act, which has been passed mid-2025, gives stablecoins and private issuers the first ever federal legal framework, full reserve backing, standardized audits, and shared oversight between state regulators and indeed federal agencies. Now that's a big step toward mainstream banking interoperability. Then there's the Clarity Act, arguably the most impactful since 1933 and 1934 securities laws. It legally defines digital assets and introduces a safe harbor for decentralized networks that demonstrate sufficient decentralization and disclosure. Now add to that the SEC's approval of Ethereum and Solana spot ETFs, which marks a psychological and institutional shift. Crypto exposure is now part of capital markets, not just crypto exchanges. The new joint SEC-CFTC Treasury Working Group finally ends years of regulatory siloing, while the OCC sandbox enables banks to custody tokenized assets directly. And FinCEN's alignment with the FATF travel rule brings US compliance into sync with global standards. In short, the US has gone from regulation by enforcement to building infrastructure for compliance. That's a profound turning point. On the Eurozone, the transformation is quieter but more complete. The Markets in Crypto Assets Regulation, or MiCA, is no longer theory, it's live. Exchanges, stablecoin issuers, and wallet providers are now operating under a full passporting rights across the bloc. The European Securities and Markets Authority, ESMA, has stepped into a more assertive role, publishing detailed guidance on custody standards, market abuse definitions, and what qualifies as a compliant crypto white paper. Stablecoins are now under the watch of both ESMA and the European Banking Authority, EBA, ensuring they meet asset backing, redemption, and disclosure rules under the Title III of MiCA. The DLT pilot regime, initially limited to tokenized equities and bonds, has now expanded to cover sovereign debt and even ETF structures, which means traditional financial products can now be fully tokenized and traded under a unified EU sandbox. I think that is rather interesting and novel. Finally, Brussels is drafting a tokenized finance directive slated for 2026, meant to bridge MiCA with emerging DeFi and real-world asset markets, completing the EU's regulatory circle. So while the US is legislating its foundation, Europe is already operationalizing its digital market infrastructure. So what happens on the ground? If you're issuing tokenized securities or RWAs, the EU now offers more predictable compliance paths, and the US requires heavier legal structuring. Investors may indeed arbitrage between regimes. Capital may flow into EU-registered token products more quickly. Stablecoin issuers. Now, Europe may lead in regulated euro stable issuance, while the US will dominate the dollar-based rails. Looking on the topic of builders, the protocols, the custody providers and the like, will prefer jurisdictions with clear rules that may tilt more innovation towards EU over time. Cross-chain and cross-jurisdiction interoperability matters. Building bridges that fit both compliance regimes is going to be a competitive advantage. These are not theoretical, these are the choices your projects and allocations must respond to. Now let's be honest, both regimes have blind spots. In the US, ambiguity reigns. Many tokens still fall into grey zones of securities law. Enforcement is heavy, and new rules may overturn assumptions. Whilst in the EU, MiCA is new. Interpretation gaps remain, such as DeFi, staking, decentralized governance. Enforcement consistency across member states is a risk. Now, on the topic of cross-jurisdiction conflicts, now what's compliant in EU might violate US law and vice versa. Now, with speed of implementation through the delegated rules and guidance in the EU may lag behind market innovation. And finally, regulatory capture and lobbying. Rules may shift as incumbents push back. Any project must watch not just today's law, but tomorrow's court, guidance, and indeed executive actions. Now, what do we need to watch out for in the coming months? In the case of the US, the passage of crypto-friendly bills or clarifying legislation, the SEC publishing rule changes, and enforcements in high-profile token cases. Also, the continuing raft of ETF approvals and rules for tokenized securities. And on the side of the EU, ESMA gaining supervisory powers, national authorities issuing harmonized licenses, delegated MiCA regulations filling gaps, stablecoin issuance in euro under MiCA, euro stablecoin adoption, cross-border sandbox coordination mechanisms between both regions, between the US and the EU regulators, guidance on DeFi, staking, and lending in both regimes. Now, these developments will decide ultimately where the majority of institutional innovation lands. So I want to leave you a last summary because there's quite a lot that I've tackled, and it's quite important to understand the actual differences in the crypto regulation in both the US and the Eurozone. So here's what we've learned from comparing both regimes. In the US, we're still seeing policy by enforcement. We've got the SEC, the CFTC, and indeed the Congress are wrestling for control that leaves innovators in a holding pattern. Every product rollout carries legal risk. Meanwhile, the EU's MiCA framework has flipped the script. Instead of chasing cases, Europe built a rulebook that provides predictability, licensing pathways, and indeed reporting standards from day one. That means capital can plan long-term and infrastructure partners can actually scale. Put simply, the US still has the world's liquidity, that is true, but Europe now has the regulatory green light. And the next liquidity cycle, the one powered by tokenized real-world assets and Bitcoin, will reward whichever region fuses both clarity and depth the fastest. If you're an investor watching this, the signal is simple. Follow the clarity. Jurisdictions that define the rules will attract compliant liquidity, ETFs, and custody solutions. Keep a close eye on MiCA's rollout across the Eurozone, especially how it's treating stablecoins and tokenized securities. Now, those categories are drawing banks and sovereign funds, not just crypto natives. In the US, the ETF pipeline and the new FASB accounting rules could indeed ignite another round of corporate Bitcoin adoption once the macro picture steadies. So don't just hold coins. Diversify into platforms and protocols that are built on the regulated rails. That's where institutional flows and long-term returns are likely to compound. And if you're a builder, this next year defines your runway. Start aligning your tokenization model with MiCA compliance standards, identity, disclosures, and reserve backing. That will future-proof your access to banks and payment providers. At the same time, prepare for dual jurisdiction licensing, one foot in the US for liquidity and one in the EU for compliance. We're entering an era where cross-border credibility matters more than speed of deployment. Most importantly, build bridges, systems that connect TradeFi, DeFi and compliance without sacrificing decentralization. That is the bottom line. The winners of this cycle won't be those chasing speculation anymore. They're the ones designing the financial infrastructure everyone builds on top of. I've actually pulled together all of the references which corroborates each and every slide above, so you can refer to if you need to do some further digging. So I'm just going to turn one by one. This is the first slide reference. This is the second one. And you can see I've actually packaged the references of the URLs by each slide number in the presentation. Right, so that's all I have for you today. It's a lot that's going on in the crypto regulatory standpoint in both the US and the European Union. And I felt it was very important just to give you that deep dive. And I will be publishing quarterly updates on different jurisdictions and regions around the world. And I'm going to be rotating amongst the different regions every single quarter because, as I said before, it's still moving parts. The crypto regulation is still quite new in fair, and a lot can change from one day to the next. So this is all the more reason why I'm going to be issuing quarterly updates on the state of crypto regulation by regions. And if you have any special requests that you want to narrow down into a particular country where you live, then please drop your suggestions in the comments in this video. So if you enjoyed today's episode, please don't forget the like button, to share the video to colleagues, friends, and if you haven't done so already, please subscribe to my channel, as I regularly publish some interesting videos such as these, anything to do with Bitcoin, real world assets, and the future of finance. Until next time.